Goes, hello, Andy, Joe, Big Al. Hope all is well. This is Nick from Ohio. Big fan, loyal listener of the show, especially the derails. I'm 47 years old, driving a 2020 Jeep Grand Cherokee. My wife and I have an Irish setter at home. See picture. Oh, very cute.
Yeah, good looking dog.
Got a lot of hair to take care of.
Yeah, that's what I was kind of noticing too.
Yeah, he may shed.
That's why he's outside.
Right.
My financial advisor, fiduciary, loves to buy security. Is he calling him a douche?
Yes.
Like a
That's what it looks like.
That is the way it is spelled. I think
You
that is
think
a
he
new
did that on purpose?
certification. That's a new designation.
Do you think he did that on purpose, or
Absolutely.
he didn't know how to spell fiduciary?
No, that's for real. That's
No,
intentional.
He's a fidouche. Loves. He's a fiduciary. That's funny. All right. Loves to buy securities at a high price, hold them, ride them all the way down, and then sells them at a low price.
Yeah, that explains the title.
Yeah, the fidouche. I will be able to tax loss harvest for many years to come. This is a big point of contention with me, as in, call me crazy, but shouldn't the individual have a plan to deal with losses? As I understand, I will have many over the years. However, buying something for $154 per share and then writing it down to $44 per share and then selling it doesn't seem very efficient to any of my buckets. We have never had a discussion on market downturns and or losses. I've been very hands-off and want to have this conversation at our next meeting, but sure, if it's even something advisors would even want input on. So he's got a couple questions here. He's going to ask Fidouche. What kind of percentage of loss should I implement with the advisor before selling? Okay. Should I, the customer, be setting these rates on losses? Thanks again for all the time and everything you put into the show. Peace, Nick. Okay, so Nick's got a broker. Nick's broker is managing his money in buying individual stocks. And the market turned on some of the individual stocks that Nick's broker purchased. And he purchased them at $1.54 a share and then sells them at $44 a share. And Nick is like, okay, that's great. Thank you. However, it created a capital loss if it's in Nick's brokerage account. So a couple of things. Sometimes people get confused with losses. And if you have a loss in an IRA, it's just a straight loss. So if he's managing money in an IRA or your 401k or any type of qualified plan, Roth IRAs, the loss is a loss. You can't take any tax benefit from it. If it's in a brokerage account, then that's a capital loss. So he bought it at $150 and sold it at $50. Well, he has $100 loss for every share that he owns. And that $100 loss will sit on his tax return and will offset any gain that Nick receives in the future, dollar for dollar. So his questions are, Al, what percentage of loss should I implement with the advisor? So, like, does he want to have a stop loss on the overall account and saying, hey, I don't want to lose this much? Or is he thinking more, what are the barriers from a tax loss harvesting perspective? Because if you've got individual securities, it's very difficult to tax loss harvest. Because, I mean, you could buy a falling knife and, the company could go bankrupt and the company goes to zero. Tax loss harvesting works a lot better with index funds or ETFs, where you have a big basket of hundreds or thousands of companies that you sell one ETF and buy another, because the probability of 1,000 companies going to zero is a lot less than one company.
Exactly. And because he's talking about tax losses in terms of harvesting, I think that's what this question is all about. And I would say just the same thing. It works way better with funds So, but you have to have an alternative fund that's similar to the one you're selling. So you sell fund A, you buy fund B. So you're still in the market, you will receive the recovery. And if you like fund A better, you just have to wait 30 days to get back into sell fund B to get back into A. If you're doing this with stocks, you can do it. It's just a little more sloppy. Like for example, maybe you've got Home Depot that went way down and you sell it and you buy Lowe's because it's similar. It's not the same company, but at least it's similar. It may have similar characteristics, but you never know because it's a separate company. That's the risk that you take. And then in 30 days, you could sell Home Depot and get back into Lowe's if that's what you wanted to do. But I like doing it way better with funds. It's way cleaner. And in terms of what percentage loss, if that's what you're asking, any loss that's meaningful to you. If it's a couple of dollars, I don't care. But if it's $1,000 or 5,000 or 10,000, whatever's meaningful to you, go ahead and take that loss. Go through generally the cost for selling, for trading is pretty insignificant. In some cases, it's free, depending upon who you're doing it through. So whenever it's meaningful, go ahead and take that loss because you're right, Joe. It's available for gains dollar for dollar. And if you have more losses and gains, it carries forward to the next year. You do the same computation. If you never have a gain the rest of your life, you at least get to take $3,000 against ordinary income. A lot of people get those two things confused too.
So a couple of things in this volatile market. For those of you that have a brokerage account, you might want to take a look. If you have some losses in some mutual funds, you might want to sell those securities and buy something similar. Take the loss. It sits on your tax return that you can offset for gains when the market recovers. So a lot of people have losses in their overall accounts right now. So take advantage of the volatility of the market from a tax perspective. But if you're asking us, hey, I've never experienced a loss before because since I've been an investor, the market's only gone up and now he's buying stocks. And should I put a stop loss, not from a tax perspective, but just from an investment perspective? That's way out of our league. No one has that answer. No one has a crystal ball. And so he bought that individual security thinking that stock was going to outperform the entire market. It didn't. It did the opposite. And so it went down and he thought it might go back up and he didn't want to sell it. And finally he was like, I got to get out of this thing. And so he sold it. So, I mean, that's the problem with people trying to time markets and buy individual stocks.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.